For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Welcome back. Another fine episode of Managing Your Financial Future. Happy to be here. I'm still saying Happy New Year. May I say that to you, Professor Rick Plum, Certified Financial Planner Professional?
Again? Yes, you can say it all year for all I care.
I can't say it all year. I think I said this before. There's a point at which you sound ridiculous, but there's also a point where you kind of stop saying it. But I'm going to say it. As long as you're still in January, I'm going to say Happy New Year to you. So, and anybody else who happens to be joining us on the podcast, either for the first time or for the first time this year. Happy to have you here. We want to talk about something. You know, I like to talk strategy, Professor Plum. You do too. I mean, this is always fun when you talk strategy, especially when we talk about buckets or tax strategy or some of the stuff that people don't talk all that often about. We talked a couple weeks ago about Social Security and the disappearance of the WEP and the GPO. That was fun.
That's good.
It is good, and that was a good thing. So today we'll lighten it up a little bit, I think.
Lighten up, Francis.
Well, I just I don't normally like to do topics that they might have on any website that you can dial up, any Market Watch or some of these things. But this is not that kind of topic. But this whole idea of financial New Year resolutions is kind of important. And it occurred to me when we were talking about stuff at the end of the year last year. I think it was our last live podcast of 2024. And I thought, well, this is stuff that where we talked about, well, we should have made, things you can do at the beginning of the year. Let's talk about some resolutions that people can make from a financial standpoint. And I'm not going to just, do the usual stuff. I'm going to do things that are really, really practical that I think people can use. Is that a long enough of a disclaimer that says we're not just going to, do a...
Well, let's see where we go with it now.
Generic episode. Well, that's probably true. And if it's no good, we'll scrap the whole thing and do a different one. But these are important things, and this is why. And I wrote down a few. And I thought maybe you can just comment on some of these and you can take these a bit further. Oftentimes when clients meet with their financial professionals, they're at their, I would guess, most motivated in many cases to get things done during the first month, maybe 2 months of the year when there's still time. Would you agree with that?
I think so, because they were obviously motivated enough to go and see somebody. And that's the hardest thing, is to get up and go and actually ask for help. Asking for help is one of the hardest things we have to do in any discipline of our life, not just finance. I mean, that's just not easy to do. But this is not just for people that go see financial planners. This is for people who are trying to do it themselves. We want to have some kind of strategic plan going forward. We want to have a plan to go forward. But how do we know so we set a plan, but how do we know if we're continuing with that plan? We got to evaluate that plan from time to time. We need to see where we're at from time to time. And the beginning of the year is a convenient time to take a look at everything. We've gotten our 1231 statement. We know what we did. We know where we were at the end of the year, beginning of the year. So we can evaluate that year over year. We can say, where were we at 2023, 2024? Have we made any progress? And have we made the appropriate kind of progress? Have we made the progress that we thought we were going to make? Rather than just putting it together and never checking it again, whether you're working with an advisor, hopefully the advisor's doing this for you, not just at the beginning of the year, but every time you meet. But if you're doing it on your own, you got to have some kind of a barometer to take. Am I doing okay? Am I am I anywhere closer to my goal than I was a year ago?
Yeah, exactly.
Or however much time you're dealing with.
That's true. So this is a good time when people are motivated, as I said, to do this. So let's run down a few of these, and you can tell me your thoughts on these. One of the things that is great to do at the beginning of the year is to set up automatic drafts. It's good to do any time, but man, especially at the beginning of the year.
Well, it's nice to think about winning the lottery and getting this big infusion of cash and building a net worth the easy way that way, but it just doesn't happen for the most part. That is not realistic. The way that most people are going to have to build their net worth, especially their retirement net worth, is over time, systematically. And if we wait until the end of the month to say, okay, I've got some money to save, there's almost always too much month to compare to the money, and we don't save as much. But if we set it up on automatic, we end up with this. It's amazing how when you set up an automatic deposit or automatic contribution to an account, and it happens, you at the end of the month, you end up with about the same amount of money in your checkbook that you would have anyway. Yeah. The difference is you save some of it. You just don't know which budget item it came out of. The budget item it came out of was that big black hole miscellaneous. When people do their budget, they've got, okay, gas and electric, food, this, that, and the other thing. And then one of the biggest pieces of the budget is unknown. It's a miscellaneous. But just start. I don't care if it's $25 a month. That's what I did 100 years ago. I started with $25 a month and got used to saving 25. If that's what actually 25 was a bigger number in reality back then, it seemed like. And then I increased it and I kept increasing it. So setting up, they talk about the 3 rules of real estate investing: location, location, location. The 3 rules of net worth investing is automation. Yes. Set it up on automatic. Get it done. Don't wait for you to do it. Have it done for you.
Yeah, I would 100% agree. And the success, I think, that most people have with their 401ks.
And now's the time to be looking at the 401k. What were you doing last year? Bump it up. Even if it's only 1 or 2%, bump it up. You bump it up, and most 401ks now have automatic escalators, the ability to set an automatic increase of 1% every quarter, every 6 months, every year. So it automatically increases your contribution number. Set that up and do not just the automatic contribution, but the automatic increase to that contribution. It's amazing how if it happens automatically, it just makes life easier. Now, that doesn't mean that you can't go in and say, you know what, we've been doing fairly well. We're getting things. We had this paid off. We're doing this. I was talking to somebody just this morning, and they were talking about we are paying off a certain loan that we're not going to have another loan. So we got an extra $500 a month. What should we be doing with that? And so we talked about what their options were with it. But that one of their options is to increase the 401k, either Roth or traditional. Increase your Roth contribution if you're doing IRAs. Increase your savings. Now this all assumes that you don't have 29.9% credit card debt out there too. Mm-hmm. But this is a way to potentially help pay off that credit card debt too.
Yeah. Yeah, the automatic nature of it, though, to speak to that point, if I could say that, the automatic nature of it is really what I think does people the most good. I would suspect, and I think you've said this before, that many people, when they get to retirement, one of their, if not their largest savings account, comes from their 401k. Not that they were actively saving so much; it was that they were passively saving. It just became automatic, and they don't touch it, they don't see it, and when you do that, Professor Plum, magical things can happen.
And I like the idea of passive 401k because when people get active about it, they tend to shoot themselves in the foot. But passive to an extent. I like the passive idea of picking some good mutual funds in your 401k, the growth-oriented ones if you're younger especially, and letting them do their thing. But actively manage, on the positive side, your contribution. Actively work to continue to increase that contribution so that you have. Now, it doesn't have to be the 401k, but that's one of the easiest places to do it. And at this time of the year, now is the time to do it, because if you are trying to get towards the maximum, the 23.5 for 25, it's a matter of, it's easier to do it if you start now and you have 11, a little over 11 full months to contribute to it than to try to change it in June and only have 6 months left to try to max it out.
Yeah.
So now's the time.
When I speak of the passive nature, it's really just do it so that it comes out of your paycheck automatically. And as you mentioned, the automatic escalators, if you can, give yourself a 1% or 0.5% higher.
They pretty much have to go in whole percents.
All right, whole percent. Well, you never know. But let's say, okay, a whole percent. Are you going to notice that you're getting as a net check the following year, 6 months later, whatever it is?
You're probably not going to notice
less.
the 1%. Heck, there's enough other taxes and fees and everything that hit us that 1%'s not going to matter there.
Yeah, and there are some people that get raises once a year. I don't know if it's everybody. I don't even know if it's most people, but there are some. And in that case, maybe that's a thought, well, okay, let's say I got a 3% raise. Let's take 1% of that raise and let's put it toward the 401k. So the obvious takeaway from this, Professor Plum, is that make it automatic. And we can't stress that enough. And that's one of the reasons why I think that's one of the first things that you can do. Not just a 401k, but other things, other ways to save. Do you know of other ways to save where you can set it up automatically? They used to have Christmas clubs. Remember that? Do they still have those?
Well, yeah. I don't know, but the idea was just to set up a bank account so that you saved, throughout the year, so that you had money to spend in lump sum at Christmas time, rather than trying to scramble and then going into debt, which then is a downward cycle, because now you're paying yourself back, plus you got to pay interest to somebody else when you could have just paid yourself and made a little bit of interest.
Right.
It's just paying those credit card debts are just, all of what we're talking about presumes that you don't have this. Now's a good time to work on a credit card. If you've got credit card debt, if you got debt, now's the time to start looking at, okay, how do I get myself out of this situation? And it's not going to be just an overnight thing, but you got to work on it. You got to put a plan in place, and that way you have a goal. And when you have that goal, you tend to work harder towards it, rather than someday it'll happen.
Yeah, it's an important thing to do, and I don't want to sound like scolds, but that's kind of certainly good advice. Now, another one besides making things automatic. This has to do with getting the employer match. You kind of alluded to it a little bit ago when you're talking about the 401k, but as much as you can of the 401k match. For those who don't know quite how it works, many of our listeners do, but Professor, if you would maybe explain it. The most common match is up to... Let's see. I'm going to have this.
It's probably 50% up to 6% or something
up
of that
to
nature.
6%.
But the match can be a lot of different things, and I've seen much better matches than that. I've seen less matches than that. But what a match is the employer is trying to incentivize you to save money for yourself. Now, I'm not going to say that they're doing it benevolently. There's other reasons why they're doing it, but they're basically saying, if you put in $1, we will put in some amount of money too. On your behalf into your account. And if you stay with us for 3, 4, 5 years and then you leave, all that money's yours, because there might be a vesting schedule on it. So they're not just giving you to today. You started working last week. They give you a nice match today, and then you leave tomorrow and get to take it with you. But as long as you stay with them for a little while, it doesn't take very long. You get to keep. So it's part of your employment package. They're going to pay you $30 an hour, or whatever, $50 an hour, whatever they're going to pay you. Plus, they're going to pay you this matching contribution. If you do something for yourself, we will help you do something with it, and we'll match you. The match is stated as $1 or a percentage amount for each dollar you put in. You put in $1, we put in $1. You put in 3%, we put in 2%, or something of that nature. But it's all laid out. You can always ask your HR department what it is. Now, it usually is capped off at some place. It's not going to be dollar for dollar on every dollar you put in for as much as you can put in. Usually there's going to be some kind of a cap. Like you mentioned earlier, one of the more common ones that we see is 50% up to 6%. So if you are making $100,000 a year and you put in $6,000, that's 6%. The employer will put in $3,000 into your account. But if you put in $12,000, they're still only going to put in $3,000 because they're only going to put in 50% of the 6% that you put in.
And it is dependent as obviously on how much you actually put in. So if you
now this year we have a little bit of a thing. Normally, up until this year, the matching contribution. Let's say I have a Roth 401k, and I'm putting my money into my Roth 401k. I'm not getting a tax deduction for it because it's Roth, but the employer is putting money in on my behalf. Well, up until this year, the employer contribution had to go to the traditional side of the account because they were taking a tax deduction and I wasn't paying any taxes on the money the employer was putting in. This year, we have the option to say, you know what? If I'm doing Roth, I want that contribution that the employer is putting into my plan to go into the Roth as well. And you're thinking, well, that sounds pretty good. You do have to pay taxes on it. Sorry. So if in that example of making $100,000, ignoring all other deductions and the costs of things, and I put $6,000 into my plan, if it's a Roth IRA, my W-2 still says $100,000. If the matching contribution goes into the traditional side of the house, my W-2 still says $100,000. If I tell them, no, I want that $3,000 matching contribution to go into the Roth account, my W-2 will now show $103,000. I will pay tax on that match. The employer gets a deduction either way. They don't care. But it's a matter of the government's not going to let us have a tax-free benefit and then tax-free at the end too. So
why not? Wait a minute now. They do this on the health savings accounts, or they did. I mean, but
this is one of those things that but we have the option this year.
Yeah.
No, that's that option.
We did not have that option before. It always went into the traditional side up until this 2025. So,
and we have one more year of reprieve for the higher end of it, people making more than $145,000, $150,000. It was supposed to be the Secure Act was supposed to say that if you were doing catch-up contributions, if you're 50 years of age and older, you have a more contribution limit. You can put more money into your 401k. It was supposed to be that that up to $7,500 of catch-up contributions had to go to the Roth side. Now, but then they pushed that out. We have one more year where we can have it go to the traditional side, and then next year, 2026, it will have to go to the Roth side. We don't have a choice on that.
Yeah, this is the last year as it stands now. Now, of course,
this year we have the option to go either traditional or 401k. Next year, you have the option to go traditional or 401k with your matching contribution if you make less than 150, call it 150. But if you make more than 150 next year, you don't have the option.
As of now, I happen to think a lot of these tax things, they're going to extend almost certainly the 2017 tax package, right, that was passed. It's all supposed to sunset this year. We'll see. But if you're listening to this at the end of 2025, this may not all be true anymore. Okay, so make sure you get the employer match. That's free money that we like to talk about. Free money is always good. If at all possible, try to contribute enough so that match goes.
It's what your employer is willing to pay you. Get what you're paid. Get what you need. Get everything you can.
Exactly. A couple more here. Beyond the employer match, this is an important thing to do probably at any time, Professor. But it's good to if you're paying attention to the money right now, you're paying more attention to your finances right now. Start creating some tax diversification. Now, when I say tax diversification, what am I talking about?
Well, do you want me to answer that, or you gonna answer that one? What are you talking about, John?
No.
Come on.
Okay, so when we talk,
I know what you're talking about. You're talking about when I start taking money out of the accounts, or as the accounts grow.
Yes. Is
there a difference? Roth IRAs are tax deferred, and when I take distributions, it's tax free. But I had to pay taxes on the money I put into it. Traditional IRAs and 401ks typically are tax deductible. They grow tax deferred, but I take the money out in the future years. I pay taxes on it then. Pretty much the exact opposite of a Roth. A personal investment, I pay taxes on whatever the earnings are as they're realized, whether I use the money or don't use the money, whether I spend it or don't spend the money. If I put the money into a bond, the interest that's paid each year, whether I spend it or not, I pay taxes on it. Capital gains, if I create capital gains, I pay taxes on them as I earn them. So there's different worlds of taxation with these three basic different kinds of accounts. And so having the option at retirement or when you start spending the money to say, do I want to take it from a taxable account today? Do I want to take it from a tax-free account, Roth? Or do I want to take it from my personal account, which may have some embedded capital gains, but the capital gains are less than the ordinary income tax that I'd pay on my traditional IRA, a little bit more than the tax-free on the Roth, but I'm in a low tax bracket. I may be able to get away with a very efficient tax situation. If you don't have that, then you don't have any options. If you don't have those different kinds of accounts, you don't have any options. Now, if you can do everything 100% in Roth, that to me is all the tax diversification you need, but it's rare that we can do everything we need to do in Roth. And it may be expensive to get it in Roth to begin with through conversions or contributions.
Mm-hmm. Yeah. And I knew you knew what I meant by create tax diversification.
And I did too. I was just cheesing with you.
I thought, do I really have to tell you what I'm talking about? No, of course I don't have to. You're Professor Plum. It's helpful. I mean, you may not necessarily realize it while you're saving, but honestly, it is helpful, especially when it comes time to take that money out and take those withdrawals, to be able to have a diversified accounts, to be able to strategically say, well, I'm going to take more out of Roth now, or I've got some personal money I can use. In many cases, going back to the 401k, the people's largest savings accounts are in the pre-tax 401k. And a lot of times it's great to have a lot of growth, especially if you've been contributing for 30 years. But
yes.
it's when it comes time to take the money out, and especially at required minimum distribution age, which is older than it used to be, but you're still going to have to do that at some point. That can create a real tax headache. And to have money from other sources that maybe are more tax favorable, capital gains are tax free, it can be a big help.
And we see this in retirement a lot when people are taking income, distributions for cash flow for spending. Being able to take a certain amount out of the traditional IRA, stay in a low bracket, and then supplement that with tax free from a Roth IRA, they can have the cash flow they want with a lot less income tax. They blend the different sources of income, or the different sources of account distributions, so they can create a more efficient tax situation. Because the reality is taxes are one of the bigger expenses that a lot of people have to pay, and it's obviously one that we are not really thrilled with paying, like a vacation or something. It's just the necessary evil, and if we can reduce the evil, manage the evil, be efficient with that evil, we can be a little bit happier.
It's awful. Come on, let's just say paying taxes is it's money that's gone. It does nothing. But so if you can find a way to manage them, and there are ways to do that and lower your tax bill potentially over, let's say, the long haul, certainly would want to do that. And by having some tax diversification, if you're able to get money into a Roth, great. Maybe there's strategies to do that, backdoor Roths, which is a whole other discussion. But it's important, I think, Rick, to think about things like this right now, before you kind of lose track of what you have and what you're making. When you get into April, May, June, I mean, for many people, it's like out of sight, out of mind.
Well, when you get into March, April, you're too busy dealing with doing your taxes and being mad at that.
Yeah.
When you get into May, June, now you're getting ready for summer and you've forgotten all about money, and all you want to think about is summertime. And then and then by the time you get around to fall, it's like, well, it's almost too late to do anything about it.
Well, that's it. And so another reason why we're talking about this here on our live broadcast here in January. So, all right. So before we run out of time on this topic, there's one more that I think is going to help people to start thinking about, and that has to do with setting expectations for your rates of potential rate of return, specific accounts, and maybe take some action on that.
Well, this is what, going back to the beginning when I said January is a great time to be able to look and evaluate what you're doing and to see whether or not you're progressing towards your goals. That was one of the first things we started talking about earlier in this podcast. And it's a matter of, now is a good time because it's very easy to compare year over year. We can look at the 12/31/24. We can look at the 12/31/22, 23, 21, 20, and see how have we progressed, and are we doing what we think? Are we making progress toward? And one of the things we've talked about in other podcasts is setting expectations. What do you expect your account to do this year? And so now you say, okay, my account went up by 12% or whatever the number was. is that in line with my expectation? Most of the time, if you're at 12, 13%, you're going to say, that's a little more than expectation. Okay, but not only is it a better or worse than my expectation, because sometimes it's a matter of, is it doing what other investments in this potential category should be doing? Because let's face it, a long-term growth account, we expect, 9, 10%. But the reality is some years we're going to see 25, 30%, and some years we're going to see minus 20%. Just because it's minus doesn't mean we bail out of it, because it may still be doing good because the markets are up and down. Did it do better than other things or equal to or close to what other things in that environment did? A, am I meeting my goals? B, am I in the right investments to help me meet my goals? So you're looking at it from two different situations. Am I on track? And that has to do with my long-term estimated expectation of that type of investment. And B, how did my investments do to other investments in this category? And should I be looking at making it more efficient? It's a common theme here, to meet the goals that I have set for myself.
Yeah, this is one of those things that I think people have maybe a harder time doing on their own, not because they're not motivated to do it, but I mean, it takes a certain amount, I think, of what's the word? I guess maybe knowledge about what markets have done in the past. I mean, I think what I'm saying is, I think this is where a financial advisor can be of special help, especially helpful here.
I think they can be really helpful in helping identify what your goals could be, whether you're meeting them, how you're doing against other things. But it also comes into the next area of this, in how are you doing towards your goal? And when you are, if you're 20 and you're growing it for the next 30, 40 years, you're not going to do much of what I'm going to talk about next. But if you're getting close to or in retirement, and you've got money allocated for what we call bucket number 1, safe money, and we're drawing that down to live. Bucket number 2, moderate midterm money that we're going to refill bucket number 1 with as we draw it down. And bucket number 3 is long term. When do we refill bucket number 1? When do we refill bucket number 2? When do we take advantage of what the market has or hasn't given us? Now is a good time to be looking at your overall portfolio and saying, are we up and more than expected in our growth fund? Or growth portfolio? Is now a good time to do something that we call value averaging, taking some money off, because the market 2024 was a decent year in the market, followed after 2023, which was a decent year in the market. If we were expecting 10% a year, we've probably outperformed that maybe, but we've also been spending down bucket number 1. Bucket number 1 went from a 6 or 7 year spend down time frame. Now 2 years later, we're about a 3 or 4 year time frame. Do we want to take some cream off the table there, a little cream off the top of the wonderful pie that we've had in our market, and refill bucket number 1 now? Value averaging. Am I saying that now is the best time to sell something because it's the top of the market? No, I have no idea. But now you're ahead. If you have gone through the progress, what you're trying to do, and found out that, I'm ahead of where I expected to be on my bucket number 3. Let's take some of that excess return and refill bucket number 1 with it right now, restretch our time horizon so that if we have a downturn, we can live through the downturn without having to sell something at an inappropriate time.
Yeah, it's the important part of this when we do value averaging is that we're not looking for the top of the market. We're looking for our benchmark, our own expectations. Am I higher than where I thought I'd be? Yeah, the market could go up. I mean, there are people who did value averaging at the end of 2023. And I mean, obviously they took some money off the table and safened it up, but that's fine. We're not looking to, grab the top of the market and then sell everything off. I think that's the important distinction that needs to be made here.
This is not market timing, because I've never found anybody who can actually pick the top of the market and then the bottom of the market. And, maybe they get lucky once or twice, but it's not something that can consistently be done. Yeah. So let's find things that are advantageous to you. If your expectation was 10% long-term growth rate on your bucket number 3 and you're at 14 after a couple of years, you're doing better than expected. Don't push it.
Right, exactly. And so now at this time of year, maybe it's a good idea to say, well, what do I expect out of this market? And talk to your financial advisor, because I think they can help at least keep you grounded. Somebody might look at 23 and 24 and they say, wow, boy, S&P, what were they up? They were up, whatever it was, 20 something, I don't know. you say, well, okay, then I expect I expect 24% this year. And
well, then you are expecting a little too much. Now, I'm not saying it couldn't happen, but to expect that, no, you're on drugs.
Right. So talk to your advisor about that, because that's also part of managing emotions and managing expectations. But let's at least make some put a benchmark in there for yourself, and that way at the end of the year you can.
Now, I will say that value averaging is a lot easier if you don't have a lot of that tax diversification we talked about earlier. Oh. If all your money is in IRAs and Roth IRAs where you don't have to pay any money for capital gains and things like that, it's easier to do your value averaging. So sometimes we look at value averaging at the end of the year when we know how much room we have in the 0% capital gain tax bracket or something of that nature. But it's you got to do it sometime and set it up and do it.
Yeah, leave it to you to bring that up, right?
Hey, taxes are important. I said it earlier.
I know
taxes are a big bugaboo.
But didn't we just tell people to have tax diversification?
We did.
And you should. You should.
And the other side of it is, another thing I say, don't let the tax tail wag the dog.
There you go.
Because, yes, taxes are a pain. Yes, but you know what? They are a symbol of success.
Like
I hate to say it that way, but if I don't pay any taxes, it pretty much means I don't have any money. I don't have any gains. I don't have anything. So it's difficult to, and you can't let, I've seen it where people had a personal investment. They had it for 11 months and it went up extremely well. This has been in the past years and it's happened many times. And they want to hold out for that next month to get a 12-month holding period so that their capital gain goes from a short-term capital gain to a long-term capital gain, and it goes from ordinary income to long-term capital gain tax treatment, which may be a fairly large difference in tax cost. And unfortunately, in that last month while they were holding it, they didn't have to pay as much in taxes after 12 months because they lost most of their gain or all of their gain. Oh. So when investment has reached a point where you think it is a good time to sell it, taxes are a consideration, but they shouldn't be the only consideration.
Okay, there you go. It's important stuff. We're out of time. I think this was a really good episode. I'm going to let it. I won't trash it. It's been a good episode. I wasn't sure because as I said at the top, I think, well, is this too light a topic? New Year's financial resolutions. But no, this is all really good stuff. And it's important. The ones that we mentioned, I think, are very important. I'm sure there are some that are fluff that we're not going to throw out there. But the 4 things that we mentioned here today, Professor, I think are good things that by the end of the year, I think you'll be glad you did it if you stick with it.
I also think that even though we talked about it as New Year resolutions starting at the years, if somebody picks up this podcast in June, in July, August, September, it's information they still can put to use.
Yes.
It's good at any time of the year. Do it.
That's true. And actually people listen to these a couple of months afterwards, so any time of year that you're listening to it, this is important. Talk to your financial advisor. You want to talk to somebody like Professor Plum or any of the Lucia Capital Group advisors. This is the stuff they do all the time, and they love doing it, which is equally important. 800-644-1150. 800-644-1150. Talk to the folks at Lucia Capital Group, any advisor. Professor Rick Plum is the Chief Financial Planning Officer for Lucia Capital Group. So Rick oversees all of the plans, but they know they use collaboration and kind of a brain trust mentality, which we have always talked about. Talk to them. They'll be happy to help you out with any of this stuff. Don't forget to subscribe to this podcast. Go to Apple Podcasts, Spotify, either one of those. We hit a major milestone. I think it was 75,000 downloads. Can I say that on this podcast? I'm going to say it anyway here, which was just great. It's been a great year. Or last year, and this is going to be an even better year this year, I'm sure. But make sure you subscribe to that. Go to Apple Podcasts, as I said, or Spotify, and listen to every single episode. We've also got a bunch of guides. I try to mention this as often as I can. We have the Social Security guide, which I think we got to update again, Professor Plum. Did I say that a couple of weeks ago?
You did, because we've had some new laws passed at the beginning of this year.
Yeah, so
that changes several things for law enforcement, first responders, teachers across the many teachers. So just a reminder, if you have a pension from work where you did not pay into Social Security and you had your Social Security reduced or eliminated because of the WEP or the GPO, now's time to do something about it. Get some money back and get a bigger benefit going forward.
Yeah, they're waiting for you. All you got to do is show up. So, all right, yes, do that. You can download the Social Security Guide. You can also at luciacap.com, or you can get the Retirement Guide. We've got an Estate Planning Guide and a few others. Just type it into the search bar, and you'll get it all for free. Great. Professor Plum, I thank you.
You're welcome.
Yep, another good one. We appreciate you being here, and we'll be back next week. For Professor Rick Plum, Certified Financial Planner Professional, I'm your podcast host, Johnny Dean. Thanks for listening. It's Managing Your Financial Future. We'll talk to you folks again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client or prospective client's portfolio. Thus, investments may result in a loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. Diversification strategies do not ensure a profit and cannot protect against losses in a declining market. A value averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities, you must consider your willingness to continue purchasing during periods of high or low price levels. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial inflation risks, and special tax liabilities. Interest may be subject to the alternative minimum tax. S&P 500 Index is an unmanaged index and includes a representative sample of large cap U.S. companies in leading industries. An investment may not be made directly in an index. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and the 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Distributions of principal from a Roth 401k are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth 401k was established, whichever is longer. Your investment options are limited with the Roth 401k to those offered by the plan administrator. Charges and fees may be incurred. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.